Well, welcome to this annual evidence session with the Chancellor here at the Economic Affairs Committee of the House of Lords, and we're delighted that we are joined today by Right Honourable Rachel Reeves, Chancellor of the Exchequer, and with her Beth Russell, Second Permanent Secretary at Her Majesty's Treasury, and Stephen Farrington, Director of Fiscal Policy at Her Majesty's Treasury. I should say that we are broadcasting this session live on Parliament Live TV, and a full transcript will be taken, which is going to be made available shortly after the meeting so that you can make any corrections. Let me start, Chancellor, by asking you a general question about the economic moment that we're in. It's a time of huge economic challenges, ageing population, stagnating growth, fragile public services, the need to adapt to climate change, tariffs from the US, and our fiscal position is also very challenging, with record borrowing, the highest tax take for many years. Given these multiple constraints, maybe you could outline what exactly your strategy is for achieving growth, the thing that you've consistently made your main priority. And I guess slightly more pointedly, how can you restore healthy levels of growth without either borrowing more than your fiscal rules allow or boosting current spending more than your tax commitments allow?
Well, thank you very much, Lord Wood, and it's a real honour to come and address you for the first time as Chancellor of the Exchequer, so thank you for giving me that opportunity today. As you say, we are living in an age of insecurity today, and economic policy has to respond to the moment which we live in. At the same time, we also have a challenging economic inheritance with high levels of tax as a share of GDP, historic high levels of government debt, and then also economic growth that really for the last 15 years has been very poor by historical standards because of the weak productivity growth that we've experienced in that period of time. But just to sort of go to the first point that you raise about the sort of economic moment and that age of uncertainty and instability in which we're living in, the growth strategy has to be the right one for this era. You know, in different areas, a different growth strategy would be appropriate, but we have to respond to the times we live in. And so that's why our growth strategy is about building resilience and stability. And we've sort of got these sort of three pillars that we think about in terms of our growth strategy. First of all, the pillar of stability, then the pillar of reform, and then the pillar of investment. So I'll just take you through those in turn. But I think also, hopefully, that will explain how they link to the fiscal rules that I brought in the budget last year. So the first pillar is around stability, and that means having fiscal rules that you stick to, because there's always fiscal rules, but they tend to change quite regularly. And so the sort of fiscal rules that we've introduced both embed stability, but also prioritise investment. So the stability rule is that we have to get day-to-day spending funded by tax receipts. That's something that hasn't happened for, well, at least a couple of decades. And the second rule is the investment rule, and I'll come on to that in a little bit, but getting debt down as a share of GDP, but subject to that being able to invest in things that improve our productivity performance. So separating out day-to-day and investment spending, because otherwise it's just too easy to squeeze investment spending, which is absolutely essential for delivering that long-term growth. So stability is the first pillar, and it's that stability which has enabled the Bank of England, the MPC, to cut interest rates 4 times in the last year. And despite the challenges, and we have faced challenges this first year, and the international geopolitical backdrop is probably not one that any government would want, but that is what we have. But despite that, in the budget, in the spring statement, and in the spending review, we showed that we were able to stick to those fiscal rules, that we had the political courage and strength to stick to those fiscal rules, and we will continue to do so. The second pillar of our growth strategy is around reform, and that reform is really wide-ranging. So reform to the planning system, and planning and infrastructure bill is before your House at the moment. And I would encourage Lords to, when they're looking at that bill, to think about how quickly we can get it signed into law, because the quicker we can do that, the quicker we can actually get things building in Britain again. And one of the big challenges we've faced, and it's a similar challenge to other countries as well, is the difficulty in actually getting things done, whether it is building transport infrastructure, energy infrastructure, the homes that we need, the digital infrastructure, which is so important now with the growth of data centres and technology and AI. So being able to get things built. So the planning and infrastructure bill is absolutely crucial to that. We've got the pensions reform, which is unlocking long-term patient capital to help grow our economy. The regulatory reform, which you would have seen at Mansion House. You also would have seen from what the Environment Secretary and Sir John Cunliffe have done in terms of water and regulation of the environment. And trade policy is also an important area of reform, where in the first year of this Labour government, we've managed to be the first country to get a trade deal with the US. We have got a reset with our relationship with the European Union. We have agreed a trade deal with India, and we are progressing trade deals with Switzerland, the Republic of Korea, and also the GCC. So that's reform. And then the third part is investment. And investment is a mixture of both public and private. So the fiscal rules that I set out in the budget last year have unlocked an additional £120 billion of capital spending during the course of this Parliament, which is why in the spending review I was able to set out £750 billion of capital spending during the course of this Parliament. And then using financial transactions, particularly through the National Wealth Fund, the British Business Bank, we're also able to unlock further investment in line with those fiscal rules, which now count the assets, the financial assets on the government's balance sheet, not just the liabilities. And that's the right thing to do, and it has enabled us to make decisions like we did today, to come to final investment decision on Sizewell C, which will, when it's built in a decade's time, provide the equivalent of electricity for 6 million homes for 60 years. That is a big achievement, but would not have been possible without those changes in the fiscal rules. I know it's a lot of detail, but that is my growth strategy.
Thank you for that full answer and strategy. Just a quick follow-up then. Obviously the UK economy is having issues. The growth is still rather sluggish. Unemployment is increasing. Inflation, as we found out this morning, is still a stubborn problem. What's your diagnosis of the ills of the UK economy? What are the problems that continue to plague the UK economy at the moment?
The key problem is productivity, and sort of investment is the answer. Investment in human capital, investment in physical capital, and also investment in new technologies. That's both public and private sector, but I think we've got the lowest private investment and lowest total investment as a share of GDP of any country in the G7. The result of that is that our productivity performance has not kept pace with our competitors and similar countries around the world. And that's why the fiscal rules that I've set out do treat investment spending different, because what you saw, and you saw this in the previous Parliament, and the plans that we inherited saw public investment as a share of GDP fall to 1.7% to GDP, and we're instead going to keep it at 2.5%, 2.4, 2.5% of GDP. The easy thing to do as a Chancellor is to cut capital spending, because, frankly, you're not likely to be the government that sees the benefit, the full benefit of that capital spending. But we're not going to keep making those short-sighted, wrong decisions, which is why we set out those changes to the fiscal rules. But productivity, I regard as the key reason why our performance on government borrowing and debt, why our performance on GDP and our performance on inflation have all been not where we would want them to be. And my job as Chancellor is to turn that around.
Thank you. A brief follow-up from Lord Blackwell.
Thank you. Chancellor, I just wondered, you mentioned the high levels of taxation at the moment, which, as you say, have been rising in recent years. Since the war, no government has, until now, managed to get more than 35% of GDP in taxation. It's now about 37.5%. Do you have a view on what is sustainable in terms of levels of taxation? I mean, the OBR, as you know, forecast that with the ageing population, government expenditure could go up to 60% of GDP within the lifetime of current young people. Do you have a ceiling or view on what is the right level of taxation in the long run once you get through the current debt problem?
So the OBR forecast for this Parliament have in the final year of the forecast period tax as a share of GDP at 38%. That's not a target, but that reflects the fiscal rules that those are the things that are my constraints and are the anchor for fiscal policy, are those two fiscal rules rather than a tax to GDP ratio. What I would argue is the best way to reduce that ratio but still have public services that we need is to increase the denominator, to increase GDP. And that is where all my focus is, because if we can grow the economy, then you can reduce that ratio without cutting investment in public services. But I also say that public services is not just about money. We've got to reform the way our public services work. That's why we did a zero-based review as part of the spending review. First time the government's done a zero-based review since 2007. And in that zero-based review, we managed to find bits of government spending that we just didn't need to do anymore. In the Treasury, we are cutting the cost of government by 20%, and that admin reduction is the same for all areas of government. Of course, in the Treasury, it bites a bit more because almost everything we do is admin costs. So I think the way, if you want to reduce that tax burden, is to increase GDP, and that's what I'm focused on.
So your target would be to decrease that ratio rather than allow it to increase?
Well, I've got to set out my fiscal rules, and those fiscal rules are not a tax as a share of GDP rule. It's a stability rule to balance day-to-day spending with tax receipts, and investment rule to get debt down as a share of GDP. The 38% is where we end up at the end of this period. But my focus is on growing the economy, which is what I think the investment rule really enables, and the stability rule means that the Bank of England can continue to cut interest rates as they've done 4 times in this last year.
Lord Pettiger, over to you.
Chancellor, my question is about the rolling debt target framework, and you may recall that in its national debt inquiry, this committee was very critical of the concept because it can be gamed, and I quote, allows the possibility of debt rising for 4 years with success being claimed if it falls in year 5, even if debt at the end of the 5-year period is higher than in the first year. I should say that is also compounded by there's a sense that there's a systemic bias, optimism bias on our growth forecasts. And so the question is, given that you have retained the existing rolling target system, does this mean that we should heavily, or the market should heavily discount claims to meet the stability rule based on future tightening?
Thank you very much, Lord Pettigas. We have changed that the 5-year to 3-year. And so in the first year, it was 5 years, then it becomes 4 years, then it becomes 3 years, and then it rolls 3 years after that. So for the first 2 years, actually there's no rolling, we just move towards it. And the 3-year is trying to get us out of this situation where it's always in the next Parliament Lord may be virtuous, but not quite yet. So the whole point of bringing it forward 2 years is so that the horizon isn't too far in the future, and also because of debt dynamics, you can't you can't game the system, because if you are taking on more debt, then you have those debt servicing costs that push up the debt to GDP ratio in future years. So I think the 3-year target is the right one. You'd never want to have it for that year, but I think the 3 years is right. But if you look at the OBR forecasts, it has us currently meeting both rules, the stability rule and the investment rule, 2 years early at a 3-year horizon, not a 5-year horizon, and it has both debt to GDP and the deficit as a share of GDP falling over that 5-year horizon. So it's not flat and then falling in the 5th year, which is, I think, the criticism of how the system has been gamed in the past. I don't want to meet the fiscal rules in that way. I want to genuinely meet those fiscal rules with policy that is sustainable, which again, to come back to this point, it's why we've taken investment out of the stability rule, because I don't want to be in a position where you cut a major transport infrastructure project or an energy infrastructure project, or you decide you're not going to build 300,000 homes a year, you're going to build 50,000 this year because you can't afford it according to your fiscal rules. So I think we've got the right balance there, but recognising that a 5-year rolling target means, I know you never get to 3 years either, but 3 years is a bit nearer, and the debt dynamics means it's harder to game the system.
I think that the point I'd just add, if I could, is that the 3-year period is also the duration of the spending review period. So that 3-year horizon is covered by spending plans that are detailed and at departmental level. So I think that guards against some of the sort of Augustinian approaches that you've seen in the past for those sort of rolling targets.
I may just one more question. And so is it fair to go back to the comment on, and your comment on GDP being effectively the GDP growth, or productivity growth being the core variable and the whole multivariable model? We had the OBR come here. We also had the Bank of England come. It seemed to me that there was a debate, the OBR being a little bit more optimistic than the Bank of England. And so the question, I think the big risk in this 3-year, even if it's reduced, is whether these GDP forecasts are hit or not. And therefore that, I think, must be the key variable.
Well, I mean, that is a statement of fact, Lord Pendergast, and as you rightly say, the OBR forecasts for productivity and growth are substantially higher than other forecasters. We are at the moment on track to meet the OBR forecasts for growth for this year, but growth is not exogenous. We can have an impact on growth, and that's why we're pursuing these policies around reform and investment to try and make Britain the most attractive place to start, to scale, to grow a business, and also for inward investment to come. And today, when we announced final investment decision for Sizewell C, not just government money going into that, but EDF investment, Centrica, Amber, and the Canadian Pension Fund, CDPQ. I think that shows that Britain is increasingly an attractive place to invest, and I think in the first year of the government we secured £120 billion of inward investment, and today's announcement, of course, is on top of that.
Thank you very much. Lord Lonsborough.
Good afternoon, Chancellor. Can we zero in on what you describe as the key problem of the economy, which is the critical issue of low levels of productivity in the UK? And we continue to lag France, Germany, the US by very wide margins, about 12 to 20% in terms of output per hour. And we have done so for decades. Now, the UK's productivity in this first quarter has actually fallen by 0.2% compared to a year ago, and it's standing now at just 1% higher than it was 5 years ago. And it may well drop in Q2, given what's happening to GDP numbers. So my question is, how is the government seeking to address this productivity challenge? What specific policies will turn the dial, and when can we expect to see results?
Yeah, so there are sort of three things that that affect, I guess, the productivity numbers. It's physical capital, labour supply, and that's the quality of the labour supply, so human capital as well as the numbers, and then total factor productivity, so technology. On capital, I'd say, sort of an assessment of the first year. I think on physical capital, that's where we've done most. In this first year, I've mentioned the £120 billion of extra CDEL capital spending by the government over the 5-year period, keeping capital spending by government flat as a share of GDP rather than it falling actually quite substantially, which is the plans that we inherited, but also using financial transactions through the National Wealth Fund and the British Business Bank and other public financial institutions to have additional capital spending, and then using things like the National Wealth Fund to leverage in private investment, 3 times as much private investment, and actually that's the model we've used as well for Sizewell C, where the National Wealth Fund is the sort of debt underwriter for that project. And as I said to Lord Pettigas, we've managed to bring in £120 billion of private investment just in this first year of the Labour government. On labour supply, you would have seen, despite the increases in the unemployment rate, we've also seen an increase in the employment rate. And those two things can obviously be consistent, because what we've seen is a reduction in economic inactivity. And that's really positive, because we are still the only OECD country, I think, that's got a lower participation rate in the labour market than before the pandemic. And so reducing those economic inactivity numbers are absolutely crucial. The first step is that you move from being inactive to looking for work, and then hopefully you move into work. And there are still around 650, 700,000 vacancies in the economy. And we want to better match the people that are available for work with the jobs that are available. And we want to help those people who are currently economically inactive, whether that's because they took early retirement and maybe now perhaps regretting that, and that is the experience of some people during the sort of COVID period, whether you are a parent who is struggling to balance work and childcare, or whether you're one of the growing number of people on sickness and disability benefits, where we know that there are many people who are desperate to work but are not given the support. We also, in the spending review, invested significantly in both apprenticeships and further education, because that has been the sort of Cinderella service of the education system this last decade and a half. It's great that we've got 50% of kids going to university, but the 50% who don't, which in my constituency in Leeds Western Pudsey, there'll be the majority of kids don't go to university. So investing in FE and apprenticeships is really crucial for this government and our wider objectives around opportunity. So we've done some of that spending review, but I certainly think that's an area where we can do more to address the productivity issue through improving labour supply and human capital. And then the last thing is around sort of technology, total factor productivity. And Andy Haldane, former chief economist at Bank of England, talks about this long tail of low productivity firms. And the DSIT secretary, Peter Kyle, he's sort of got 3 focuses in his area. First of all, it's attractive businesses that are at the technological frontier. Obviously, that is crucial for growth, and we're very good at that in Britain. We've got a lot of very high-skilled people. I was at Imperial College this morning. That's an area where we are good, but we shouldn't rest on our laurels. The second area is using technology better in delivering public services. That's this issue about not just how much we spend on public services, but about getting value for money. And then the third is the sort of point around that long tail of productivity, about better take-up of AI and technology by smaller businesses and less productive firms. And so we're working in all of those areas, and there is a big opportunity. The IMF and others say that if we integrate AI and technology, we could boost productivity by 1.5%. Over the next 10 years. So there's huge opportunities there, and we've got to seize them, but we are very focused, as I hope you can tell, on that agenda.
And can I ask you about the fiscal impact of continuing low productivity, in that the OBR admits that its productivity forecasts are, to quote them, the most important yet uncertain forecast judgments they make. And they admit to the fact they've been successively too optimistic on productivity forecasts. And if current productivity trend forecasts that are assumed by the OBR of 1% growing to 1.2% over the forecast period to 2029 currently looks very optimistic, and certainly that's the Bank of England's view, what will be the fiscal consequences if productivity continues at the current low rates, which averaging about 0.2% per annum over the last 5 years?
Yeah, so the OBR forecast long-term productivity growth of 1.25% a year. and the Bank of England have a forecast of 1% a year. Both are very low by historic standards. Productivity over a long period of time is higher than that, but as you rightly say, the last decade and a half has been lower. So I guess you've got to decide whether you think that you should just look at a short period of time for what average productivity is, or long-term productivity, or whether you should look at a longer time series. And the OBR, as they've said, are looking at that at the moment. But perhaps I'll pass on to Steve to give a bit more detail.
Yeah, I mean, I saw the evidence David Miles gave, and I think he gave a sort of balanced assessment of where the OBR had come out, which is that they think that productivity has been depressed by a series of shocks over the last 15 years. But even abstracting from that, they're certainly not expecting productivity to return to the pre-financial crisis levels of 2.5%. Right. But equally, you can veer into the too pessimistic, into the views that the recent numbers we've seen at 0.2 are like to persist, and their view was that there were reasons both to expect that the sequence of shocks might not continue, but also that there is potential for future technologies, in particular AI as a potential new general purpose technology, to be a source of the innovation that you need in TFP growth that supports their forecast of productivity gradually picking up to 1.25%. I think one of the elements I would add is to the list that the Chancellor gave of policy measures is the impact of the government's planning reforms to support productivity, which the OBR scored as increasing GDP within the 5-year forecast, which is also a very good example, I think, of coming to your first question, Lord Wood, of how is it possible to sort of increase productivity given the constraints of the fiscal position. I think those steps on planning are a really good example of how it is actually possible to do that.
My concern is probably more about the short term, in that the current forecast in the OBR looks very optimistic and I'd say ripe for downgrade, and that's echoed by the consensus of independent forecasters. And I think the Bank of England has actually downgraded its productivity forecast to 0.6 or 0.7%. So that's going to have an immediate fiscal impact this autumn, is it not?
The Bank of England's forecast of productivity, long-term productivity growth, is 1%.
Long term, yes.
Yeah, and that's what sort of drives the models, really. But the OBR is higher than that. The number I gave you earlier was just slightly wrong. So the IMF analysis suggests AI could boost UK cumulative total factor productivity over the next 5 years by 1.4%. And so I guess that's the point that sort of Steve Farrington is making, that there have been a series of shocks over the last few years, whether it's the sort of global financial crisis, COVID, Russia's illegal invasion of Ukraine, that have all had a negative effect on productivity and growth. But actually, if you look at some of the underlying drivers of productivity, there is perhaps a reason to be more optimistic in the future if we can contain some of those shocks, in part by building a more resilient economy, and that's what we're trying to do with clean energy, homegrown energy, for example. But some of those underlying factors about the increasing use of technology might give us a bit more cause for optimism.
Thank you.
Lord Turnbull.
I don't know whether on your desk you have Kraft Hamlet's complaint, when sorrows come, they come not as single spies but in battalions. So let me pick up one of those battalions, which is demographics. Much has been written about the impact on public finances of the growth in the number of older people. Less appreciated, I think, is the alarming or certainly severe worsening of the dependency ratio. We used to think of the labour market starting at 16. Not many young people go to work at 16 these days. Sometimes it takes them until their mid-20s. The birth rate is very low. And so the circle has been squared by the acceptance of the promotion, the acceptance of very high levels of net migration. And there are also concerns of whether the people who are now coming have the same characteristics as those who used to 15 years ago, whether they want to stay more, bring more dependence. So how do you square this migration issue with protecting the public finances, the needs of the labour market, big shortages in health, care and food processing, and the social pressures that the migration is causing.
Thank you very much for your question, Lord Turnbull. Countries around the world, certainly developed countries around the world, face a number of demographic challenges. The UK is not the worst by a long way, but we do face some of those demographic challenges as well. As you would have seen on Monday this week, we launched a pensions commission to look at the adequacy of pensions in retirement and also the state pension age. I think one of the most transformational pieces of public policy in the last couple of decades is automatic enrolment into pensions. That's brought 11 million people into saving for retirement who weren't previously doing so. But the truth is, a lot of people, even with automatic enrolment, find that their pension pot is not worth as much as they need it to be worth on retirement. And so that's why the Pensions Minister, Torsten Bell, has just started that piece of work, led by, is it Susie Morrissey, is doing the Pensions Commission? I think so. I think it's Susie Morrissey doing the work on the Pensions Commission, and then Baroness Drake and Sir Ian Cheshire, and Nick Pearce, Professor Nick Pearce, are doing that wider piece of work on the adequacy of pensions. So that's important work that is ongoing. You'd also see in the pensions bill is making its way through Parliament at the moment to create those mega funds in pensions, so that when people do save for retirement, they get a better return on those savings, more similar to what you've got in Canada or Australia or the Netherlands, for example, where you've got a smaller number of big pension schemes that generate better returns for savers. And what I set out at my Mansion House speech last year, and then the pensions bill is aimed at a consolidation in pensions, and the Mansion House Accord, which we agreed with around 90% of the biggest pension funds have agreed to invest 10% of their main funds in private assets, of which half should be in UK assets. So there are opportunities here, as well as concerns around sort of fiscal sustainability. In terms of immigration to meet the sort of skills need and the labour demand in the economy, my first answer will be, well, there are a lot of people here in Britain who are not working, either because they are unemployed or because they are economically inactive. We've got 20% of people of working age who are economically inactive, and we've got an unemployment rate of just over 4%. And so I do not think that businesses should always resort to the immigration lever to fill vacancies. We need to do much more to train up people who are already in this country. There are those 650, 700,000 vacancies in the economy. There are plenty of people of working age in this economy. With the right support, they should be able to work. And that's why in the budget last year, I set out a series of trailblazers working with the directly elected mayors to help people in their mayoral combined authorities to get back to work, with a focus particularly on young people. We've got 1 in 8 young people not in education, employment or training. That is not acceptable, and we need to do much more to make sure that those opportunities are there for those young people. And it's why as well we've announced £1 billion of support to help people who are currently not in the labour market back into work. So, immigration has always played and will continue to play an important part of the skills mix, but we can't just turn to the immigration lever. We do need to do much more to train people up who are already in this country.
One quick supplementary. You said that in the past it was the easy thing was to cut capital. You changed the rules to favour capital more. But the first thing you announced, I think more or less, was the cancellation of 2 major roads projects, Arundel Bypass and Stonehenge. Would you have done that now under the rules that you are now operating now?
Yes,
because the reason you gave was they couldn't be afforded. Didn't say anything about whether they were good projects or not, it just said they couldn't be afforded.
We've set out £750 billion of spending during the course of this Parliament, but of course, through the course of the spending review, there were plenty of projects that we had to say no to, because even with £120 billion more public investment than the plans we inherited, you still can't do everything that everybody would like to do. There's always going to be more demands on public resources than we have money available, and we have to prioritise because there is not a limitless pot of money as much as people might like there to be, or sometimes think there is. So even with the additional money available, we still have to make priorities. I'd also say this, we did have to cancel things, but we cancelled things where the money was not there. There were lots and lots of projects that the previous government had announced, had committed to delivering, without allocating a single penny to pay for them. And that is how you end up in politics, with the levels of distrust of politicians and of the democratic system. And I do think it is unforgivable to make a load of commitments without having a single clue about where the money was going to come from. I'm not going to do that. And it does mean you're going to have to disappoint people sometimes, but I always think it's better to be honest than to say that you can achieve something without saying where the money's going to come from. And that's why we've just done a multi-year spending review where we've settled departmental budgets for day-to-day spending for 3 years and for capital spending for 5 years. And alongside that, we've published a 10-year national infrastructure plan. Difference between this and what we inherited is every single thing that we've said we're going to do in the next 3 years for day-to-day spending and the next 5 years for capital spending is fully funded, fully costed. And that is very, very different to the plans that we inherited. So yes, we had to cancel things, but we had to cancel things that would never have been delivered because there wasn't a single penny allocated to them.
Lord Blackwell.
Thank you. Chancellor, one of the other long-term challenges you're having to deal with as Chancellor is the rising cost of welfare. This committee recently completed a report on the economic impact of long-term sickness. And as you'll be very well aware, spending on incapacity and disability benefits has risen more than 40% over the last decade. There are currently 3.7 million people who receive the health component of universal credit, 95% of whom aren't working, and 80% of whom have been out of work for more than 2 years, tragically, many of them young. But what we've discovered from the evidence is that this doesn't seem to reflect any rise in sickness levels in the population as a whole. In fact, the survey of health of the nation has been pretty stable over that period. So the conclusion that we and many others have come to is that it has more to do with the structure of the benefits system and the incentives within it. Indeed, Alison McGovern, the employment minister, told us the current system doesn't work. It was supposed to be designed to incentivize work, and it's turned out not to do that. And it's obvious that it's not financially sustainable. So my question is, do you agree with that assessment? And I know you're waiting for the Timms report, but do you accept that if we're going to deal with the ballooning cost of credit and indeed help the people who are in this situation, that'll need much more fundamental reforms for both economic and social reasons?
Well, thank you very much for that very topical question. As you say, Stephen Timms is doing the review now of sickness and disability benefits of personal independence payments, but we're not just going to wait for that review. Before COVID, 7 in 10 assessments for personal independence payments were done face-to-face. It's now 1 in 10. I don't think anyone truly believes that those assessments are going to be as effective on the phone or on Zoom or whatever as they would be if they were face-to-face by better trained and better supported assessors. And so we are changing that. by recruiting and giving DWP the resource to have more trained assessors and more face-to-face assessments to ensure that people who need the support get it. But then people who are able to work are given the support to get back into work. At the same time, we're providing £1 billion worth of support to help people who are economically inactive back to work. And that will also include supporting NEETs, where I think that the biggest crisis exists, because we know that if you're out of work early in your working life, you are going to earn less and be in work less over the whole period of 40, 50 years that you should be in the labour market. So a real focus on back-to-work support and face-to-face assessments, as well as the TIMS review. On universal credit, we are making reforms. We are, in real terms, reducing the health element of universal credit and increasing the standard allowance, because we know that a lot of people found it almost impossible to live on the standard allowance, and all of the big charities, Joseph Rowntree, etc., say the standard allowance was not enough to live on, and so people were doing their very best to get onto the health element. And once you're on the health element, you don't have to be actively seeking employment. So narrowing the gap between those two benefits, I think, is one important way in which we can encourage more people to be actually looking for work. I'll also just give you a couple of statistics which I think are quite telling about people on sickness and disability benefits. There are 200,000 people who are claiming health and disability benefits who said that they would work if the right job and support were available. It's 200,000 people. An additional 1 million people say that they would be able to work in the future if their health improved. And so the investment we're putting into the National Health Service on both physical and mental health, as well as that targeted back-to-work support, is about enabling people and giving people the support that they need to access work that is appropriate for them. We're already seeing a reduction in the economic inactivity rate. That is really encouraging, but there's an awful lot more that we need to do to help more people of working age have the fulfilment that I believe comes from having a job.
I'm sure you'll be the first to say this isn't just an economic issue, but would you measure your success by the fact that in 5 years' time there ought to be a lot fewer people on health-related benefits and a lot more of them in employment?
Well, let's just be clear, even with the original plans in the legislation, you would have seen an increase in the number of people on personal independence payments. All our plans would have done was to stem some of that increase. I want more people to be in work. I believe it is good for them, good for their families, and good for the economy. You're half as likely to be in poverty if you are in work compared to if you are on benefits. We also need to support people in work with greater security in work, which we're doing through the Employment Rights Bill, and also by a wage that you can afford to live on, which is why we increased both the national minimum wage and the national living wage in the budget last year. So I do want to see more people have that chance of meaningful employment, which is why we're investing in skills and training, and it's also why we're putting that support in to help people back into work. And the TIMS review, of course, is looking at that gateway to sickness and disability benefits.
A related question from Lord Vergie.
Thank you, Chancellor. What are the fiscal consequences of the government's concessions to ensure the passing of the benefits bill? Does the short-term volatility in government policy undermine the UK's fiscal credibility? And how are you going to address some very painful long-term decisions we have to make with the short-term volatility in government policy at the moment?
So, as the Secretary of State for Work and Pensions said at the time, of course there is a cost for the changes on the welfare bill. The OBR will do their costings in the autumn and will set that out. probably in the tune of £5 billion. But we've restated our commitment to the fiscal rules. Those are non-negotiable because it is the fiscal rules that provides that stability that underpins a successful, thriving, prosperous economy and gives government bondholders the confidence to carry on buying those government bonds. And we are still very reliant on the goodwill of strangers in buying our government bonds. £1 in £10 of government spending is spent servicing government debt. I'm a Labour politician. I don't think there's anything progressive about spending £100 billion a year, often to US hedge funds, when I'd rather spend that money on the health service or on our defence or on better schools for our children. And so that is why I am going to stick to those fiscal rules so that we can start to bring down the costs of servicing that debt, so we can free up that money, whether it is to have lower taxes on working people than we otherwise would do, or we can have more money for our public services. So the fiscal rules are not some sort of construct from me or from this government. They reflect the economic realities and the fiscal realities of the world we live in today. And as Andrew Bailey, the Governor of the Bank of England, said to the Treasury Select Committee this morning, the world as it is today, with the uncertainties, the geopolitical uncertainties, the trade uncertainties, but also the increase in the global issuance of government debt. Take the US or Germany, for example. All of those things are pushing up government bond yields, pushing up the cost of borrowing, including for the UK. I'm determined that we don't just keep spending more and more on servicing the debt, because I believe that when people pay their money in taxes, they want that money to be spent on things that matter to them and their families, and that's what I want to achieve as Chancellor.
If Chair will remind me, I just want to go back to a question on productivity. And I know it's hard for a sort of number cruncher to talk about culture, but it seems to me a key factor of increasing productivity is culture. You know, we talk about the American dream and the success of the US. It's hard to talk about the British dream today. How does someone in your position change the culture of work, productivity? Because that, to me, seems to be a key factor in increasing productivity for our country. How do we get the British dream going?
Well, look, one of the things that I'm keen to do, and you would have seen it in my Mansion House speech just last week, is that I'm keen to have more people investing rather than putting their money into cash. I would like British savers to be supporting the British economy by giving more access for long-term patient capital for people with great ideas. We're a country of entrepreneurs. I mean, that is a great thing about Britain. A number of people have got fantastic ideas that they want to turn them into their own business, work for themselves, not work for someone else. But to do that, we do need to unlock more long-term patient capital and give those opportunities for ordinary people to save and make a return on those investments. The other thing that I would say is a sort of like quintessential British dream is to own your own home. And that dream has been snatched away from far too many people these last few years because we have not been building enough homes as a country, and that's why we've got this ambition as a government to build 1.5 million homes during the course of this Parliament, so that more people can realise that dream of home ownership, and if not able to buy a home of their own, that they have the security of a home that can't be snatched away from them at the whims of a private sector landlord by investing more in social and affordable housing. So that dream of starting your own business, which requires ordinary people in Britain to invest more of their money into stocks and shares than putting their money into cash, which serves not very much purpose and doesn't give very much return, and that dream of home ownership that I believe that we can fulfil if we meet those targets around house building. But on the issue of productivity, you know, British people work hard. You know, young people, when I go into schools and colleges, are full of ambition. We've got to find a way of capturing that and nurturing that better. You know, that's why I have always just been passionate around better supporting the 50% of young people who don't go to university. You know, at my school, where I went quite a lot of years ago now, but I was in a very small minority that went to university. The government carried on investing in my education for years, very expensively. But the girls that I went to school with didn't have those opportunities. They left school at 16 or they left school at 18, and they never had the opportunities that I had, despite being bright, because they didn't have those aspirations. Those aspirations weren't nurtured in them. And if they then wanted, a few years later, to go to college, they'd have to pay for it themselves, rather than, like me, having their education paid for. And even today, with tuition fees, we are still putting huge amounts of money into the education of people that go to university. I do want to retilt the system to help more young people get an apprenticeship, get a place on an FE course. We say 1 in 8 young people are not in education, employment and training. In my city of Leeds, there are more people who want to go to further education college than there are places available. And then we say, they're not in education, employment or training, as if it's their fault. Well, they want to go to college, but there's not the places available. So we've got a responsibility as well as lawmakers and as a government to make sure that young people don't have their dreams snuffed out at age 16 or 18 because, there's no room at the college because governments didn't make those investments in further education. That's something I'm really passionate about doing. But the productivity challenge in the UK is not because American people or French people or German people are harder working than British people. I do not accept that at all. We've got to do more to nurture the talent of people in this country.
A brief follow-up from Lord Agnew on this.
Yes, good afternoon, Chancellor. Just back to your Mansion House speech, and you put a lot of personal commitment behind driving forward tokenisation, stablecoin and so on. Mm-hmm. And you said that you wanted our financial services sector to be at the forefront of this innovation. I just wondered how you're going to do this when we have a very, very cautious regulator in the FCA and a governor of the Bank of England who has come out, again, very cautiously. How will you prevail?
So I spoke at UK FinTech Week, I think it was the beginning of April, and that was the same time that we published the draft cryptocurrency legislation, including on stable coins. We've also worked really hard, this government's worked really hard this last year with the regulators. You would have seen in my Mansion House speech last November, I updated the remit letters to the PRA, the Bank of England, the FCA, where I instructed them to regulate not just for risk but also for growth. And at the beginning of the year, the Prime Minister and myself wrote to all the regulators. That was a lot of paper because we have an awful lot of regulators in this country. And in those letters, we asked the regulators to come up with new ideas of how they could support this government's number one mission, which is to grow the economy. And the letters that I got back, actually especially from the FCA, were very encouraging, with new ideas, some of which we adopted, and I set out in the Mansion House speech last week about how we would get around 40,000 additional people on the housing ladder every year by the reforms to the mortgage lending. That was a suggestion that came from the FCA of how we could better support growth in the economy rather than just regulating for risk, accepting that sometimes you have to take a little bit more risk to earn that greater return, and in our case the return for the whole economy by helping more people get onto the housing ladder. The FCA and the Bank of England have also set up a digital securities sandbox, which is really popular, not just with UK crypto and stablecoin and digital assets businesses, but actually internationally as well. And we're attracting that investment to experiment in new products, new services for customers. Last week, I published the digital markets strategy, and key to all of this, I guess, my sort of philosophy around it is, we want to be pragmatic. We've always, as a financial services capital, been really good at encouraging innovation. And there is huge amounts of innovation going on in digital assets. We're leading the way in things like Digit, which is a digital gilt instrument, which again is leading the way for countries around the world. And we've just set up with the US a UK-US financial regulations working group, which is all part of the sort of trade agreement to build on the defence partnership we have with the US, with a technology partnership, including in areas of fintech, where Britain really is a global leader, and working with the US to ensure that we've got a similar framework for these new assets and new opportunities.
Lord Lamont.
Good afternoon, Chancellor. I quite understand that you will be reluctant to comment on potential budget measures, but I still find it a bit strange that the government hasn't ruled out a wealth tax, which some people in your party have been proposing and about which there is a lot of discussion. And although I understand your reluctance to rule things out, you did, before you took office, rule out certain increases in taxation. You were quite explicit about that. Surely just the whiff or suspicion of a wealth tax is rather undermining confidence, or carries the risk it will undermine confidence. It wouldn't be far better just to rule it out?
So in our manifesto, we made a commitment around the key taxes that working people pay: income tax, national insurance, and VAT. But you'll know from your own experience, Lord Lamont, that if you start saying no to other taxes, then as soon as you don't say no, people will assume that's the one you're going to increase. And so it is right, and this is, with respect, what you would have done and did do in my position, is that you rightly said that taxes are matters for a budget, and we'll set out our policy there.
Well, I'm sorry I can't get you to be more forthcoming. May I therefore switch the subject slightly to the subject of Lord Agnew and Lord Vergey's questions? That is the Mansion House speech and the remarks that you made about the need for greater risk-taking by investors, which I think is sensible and wholly welcome what you said. But risk-taking is not real risk-taking if it involves compulsion. And it isn't really changing the culture if what you propose involves compulsion. And therefore, the one reservation I have about what you said was the power to mandate pension funds to invest in certain assets. I understand you're only taking that in the pensions bill as a residual power, but why should you have it at all? Because that is not really going to achieve your objective of changing the culture. And could I put it to you, it's also at odds with the responsibilities of trustees of pension funds, and it also carries the risk that this power might be used to direct investments into particularly politically favourable projects. I'm not suggesting you would do that, but it is a risk. And if you really want to change the culture, you don't want compulsion at all.
Right. Well, thank you very much for that question, which I will answer a bit more freely than the last one. You'll be pleased to know. So I think there's sort of two parts to this, Lord Lamont. There's the pension side, and then there's also the retail investment. So I'll take each of those in turn. I want people to know that we are serious about pensions reform, and that's for two reasons. First of all, people have been badly served by too many pension products in the UK, that they're not getting the returns on their savings that they would do in other jurisdictions around the world, because we have got too fragmented a pension system, too many small funds that don't have the economies of scale, do not have the expertise to make the best investments on behalf of their savers. And the reason that is so bad is that when people save for retirement, they are sacrificing consumption today, and especially at a time when the cost of living challenges are as acute as they have been in the last few years, for that money not to be working as hard for a saver as it could be, I think is really letting people down. And so that's why we are, through the pensions bill, requiring the consolidation. And that's not, we would like you to consolidate. The pensions regulator will have powers to consolidate. I think that's the right thing to do because the current system is failing too many people, and the lessons from Australia, from the Netherlands and from Canada is that a smaller number of bigger schemes deliver better returns for pension savers. And so both within the local government pension scheme, where at the moment we've got 96 different administering authorities, and we're going to take that down to 8 pools, but we're not going to say you can put your money in the pool if you want to. The money will go into 8 pools. We're not having 96 different authorities managing different schemes. We're going to consolidate local government pensions because we want them to work better for savers and work better for taxpayers as well. And we're going to consolidate the DC landscape as well. We built on what the previous government did, what Jeremy Hunt did when he was Chancellor of the Exchequer with the Mansion House Agreement, with a new Mansion House Accord. And this is in the spirit of what he did, but it takes it to the next step. And that is that now 10% of assets in main funds will be invested in private assets. And I think around 90% of the biggest pension funds have signed up to this. But, and this is a sort of crucial difference, of that minimum 10%, at least half has got to be in UK private assets. And this is because we know that there are massive opportunities with infrastructure and also with private assets for growth opportunities, and we want British savers to be able to benefit from those opportunities here and abroad, but we want them to benefit from those opportunities here as well. We haven't mandated that, that's just happened. But mandation is there if things don't move in the way we expect it to. But there's no reason to use mandation because voluntarily the pension schemes are signing up to that. But that reserve power exists if we ever need to use it. The final thing that the pensions bill does is make it easier to achieve surplus extraction for some of the DB pension schemes that over the last decade or so have built up large surpluses in those pension funds to be able to extract those both for investment but also to return that money to pension scheme members. So that's what we're doing on the pensions side, and the aim is to better support savers and better to support the real economy. On retail investing, we are changing, and we will do ahead of the new ISA year starting in April next year, changing the rules around advice and guidance. Because post-financial crisis, it is almost impossible for somebody on a modest or a middle income to get advice on how to invest their money. And so we're going to make changes there. And this work is being led by Chris Cummings at the Investment Association to make it easier for providers of financial services to give a nudge to customers to say, well, you know, you've got £20,000 in cash, earning 4% a year, 3.5% a year, but actually, if you look at what's happening in stock markets, they go up by usually nominal GDP, higher than inflation, higher than the base rate. If you put money in there, if you're in your 20s or 30s, by the time you retire, by the time you're ready to buy a house, it's likely to have made a better return than just leaving your money in cash. And at the moment, you're not allowed to do that as a financial services provider. You're not even allowed to nudge somebody towards a product that might be more suitable for them. And so that advice and guidance review and the change we're going to bring in is about encouraging people to diversify and to invest their money in a way that's probably going to be better for them. Yes, it involves taking a bit more of a risk, but an informed risk based on your circumstances for many people is probably better than the status quo at the moment. We are also looking at the ISA framework. We announced the long-term assets fund, is that what it's called? Will be merged into the main ISA so that people can take advantage of those innovative products. But we didn't announce any wider changes, as you know, to ISAs. The big change we've made on retail investing is around the guidance that customers can get to, I hope, encourage that culture of investment and allowing ordinary British savers to benefit from fast-growing British businesses and new opportunities.
Just to say to colleagues in advance, we do have a hard 3:30 finish, so with apologies, we'll have to be brief in our questions in the follow-up. Lord Davis.
Okay, follow-up. Good afternoon, Chancellor. I don't want to preempt Baroness Casey's review of adult social care, but do you accept that she's due to produce a solution to an oncoming crisis? And are we building into our plans for the future as I say, I don't want to preempt what conclusion it's going to reach, but my guess is it's going to involve a lot more money. And so where is that money going to come from?
Yeah, fine. Thanks very much, Lord Davis. Baroness Casey's Phase 1 report will be published in 2026. That will look at how we can use existing resources better. A huge amount of money goes into social care, both privately funded and publicly funded. And I expect, like most public services, that money could be better used than it is at the moment. So phase 1 is about quick wins, how to use the existing money in a better way. And phase 2 in 2028 will be around the future arrangements, including around financing. In the meantime, we've set out that we're going to bring in a fair pay agreement for social care. We'll be saying more about that in the months ahead. The local government settlements that we made both in the first phase of the spending review in the budget last year and also in the spending review, the multi-year spending review last month, gave settlements for local government real terms increases in their spending, the first sort of sustained real terms increases for a number of years, as well as additional investment in the NHS of £29 billion a year. So, you know, I think there is a wide consensus that the social care system needs reforming. We are making changes ahead of the Casey review, particularly around local government funding and fair pay agreements, but recognise that much more systematic work needs to take place, which is why we've published the person who can deal with intractable problems, Baroness Casey, to do the review.
Thank you.
Lord Razzle.
Yes, I'd like to turn to the slightly thorny issue of the introduction of the rise in employers' national insurance contributions, which, as you know, has subsequently proved a bit controversial. I'm interested in what you think about the impact on employment, inflation. Obviously, the bigger companies are better organised to absorb this, although I think if you went into your local pub, if you had the time to, you'd find that the local pub, if it was still there, was complaining to you about the impact on it. Did the Treasury model the affected changes before you introduced that? And if so, what was the predicted effect?
Thank you very much for your question, Lord Razzle. So when we came to office last year, and sort of links to the question earlier on from Lord Turnbull, we did face a situation where there were a number of unfunded spending commitments, and we needed to explain how we were going to pay for them. There were choices about how to address that. We could have increased taxes on working people. We could have cut public spending. I didn't think that they were the right choices, and so as a result, we did increase taxes on business and on the wealthiest in society by around £40 billion in the budget last year, and around just under 25 billion of that came from an increase in employer national insurance contributions. Now, recognising, as you say, that smaller businesses would struggle more with that, we increased the employment allowance to £10,500. So if you're employing the equivalent of 4 people on the national living wage, you wouldn't be paying any national insurance contributions at all. That was a doubling of the employment allowance. It means around 1 million businesses are paying either less or no more national insurance than what they were previously. But of course, on bigger businesses, especially employment-heavy businesses, do face or have faced an increase in that burden. But the counterfactual would have been either higher taxes on working people who have already had to absorb the vast amount of the cost of living challenges. It would have meant cuts in public services that had already been starved of resources for many years under the austerity of the previous government, or it would have meant more borrowing, which I just don't think would be the right approach, and would have meant that the Bank of England weren't able to cut interest rates by 4 times in the last year. And of course those lower interest rates benefit both households, especially with mortgages or other lending, and also help businesses who have also paid a heavy price for the sharp increase in interest rates that we've seen over the last few years. So that money that we raised, including the national insurance contributions, we used to put our public finances on a firm footing, and also enabled us to put that additional money, £29 billion extra a year, into the National Health Service. So they were the right decisions in the circumstances that we faced, and I continue to defend those. The modelling by the Office of Budget Responsibility, I think, should be the place to go to look for the impact of policies. But you can't, in my view, look at individual policies on their own. You have to look at what the alternatives were, and I think the alternatives would have been an awful lot worse.
Yes, well, I don't want to get into a debate about that. I don't necessarily agree with you. So what you're saying is the Treasury didn't model the effect of this, particularly in the hospitality sector, but the OBR may well.
Well, you've read the OBR report, but I'll let Beth say a few words.
In the normal way, we work very closely with the OBR on their, ultimately, what are their assumptions on the impact on employment, and we fed into that closely. We also did, as we do for all of our budget measures, sort of sectoral analysis and that kind of thing, but as the Chancellor said, a lot of that is also looking not at individual measures, but looking at the cumulative impact of those across the piece.
Yeah, I'd just also say this. I've set out my policies and what this government are doing. And of course people can disagree, but then the onus on them is to say, well, what would you do? Because if you're facing a situation where you've got a lot of unfunded spending commitments, you could say, okay, fine, well, we won't do that spending. That's definitely a reasonable thing to say, and then you wouldn't have to increase the taxes. Or you could say, well, I want to pay for those public services that have been promised, in which case you can either borrow to fund that, and therefore you wouldn't have benefited, I don't believe, from the cuts in interest rates, and you would have paid higher costs of government borrowing. Or you could say, well, tax someone else. Well, that's fine, but you have to say who. But you can't support the increase in public spending unless you support the money to pay for it. And if you don't support the increase in public spending, that's fine, but you have to justify why you would not be putting in the additional £29 billion into the health service.
We would have increased the bank levy, increased the tax on the technology companies, and taxed the gambling companies. So you could have got close to 40 million in that, but now it's not the time to debate.
I mean, we could discuss that another time, but it is maths like that got us into the problems that we're in today.
Baroness Wolf.
Good afternoon, Chancellor. I'd like to go back to one of the things that you raised when talking about your reforms, namely planning and infrastructure. And I think everybody in this room is well aware of the history of the back tunnel, 359,000 pages of planning documentation before you get anywhere on the Lower Thames crossing and so on. And you particularly said that you would like the Lords to get the planning and infrastructure bill through fast. In that context, I think there has been some surprise expressed about the fact that the bill has come to the Lords with some government amendments that actually seem to make it easier than in the original drafting to block and delay things on environmental impact grounds. And I wondered if you could say a little about that, because it seems like a good moment to ask you to do so. But also much more generally, how will you know whether the planning reforms are really adequate, whether they're really cutting through? So a specific question about the environmental impact and whether or not the effect on nature is permanent. And secondly, this is an ambitious bill, but is it ambitious enough? How will you judge whether it actually needs to be followed by further planning interventions?
Well, thanks very much for engaging in this issue, because I think you know, this alongside the trade deals we've done are probably the most important things that we've done to date on unlocking the growth. That I think there's a wide consensus that we need to improve our productivity and growth performance. And yes, I think I did a Today programme interview where I sort of laid into bats and newts and lizards and whatever, I don't know about lizards, great crested newts. I think the Today programme got quite a lot of feedback, but we can't always say no to infrastructure investment. You know, we announced Sizewell C today, you know, and I see that there are quotes from, you know, the Stop Sizewell group. I understand why they have concerns, but if we say no to every new runway at an airport, every new housing development, every new onshore or offshore wind farm, every new power station, every data centre, every film studio, we're not going to boost our productivity, we're going to see it decline further. And I am not willing to be the Chancellor that lets Britain go on this path of steady decline, because it would be a path of our own choosing. And so I've chosen investment rather than that path of decline. It does mean having some fights, and it does mean taking on some people who don't want change. And I'm willing to have that argument, because home ownership has gone backwards, our energy bills have gone through the roof, and we don't have the security either of energy supply. So that's why the planning and infrastructure bill, combined with the regulatory reforms, is absolutely essential. Now, you made the point about the government amendments. We've taken two separate sets of legal advice as a government ahead of putting those down. We do not think that it waters down or weakens the bill, but it gives some of the assurances to, frankly, encourage people at your end of this building to get on and do what we need to be done, which is to pass this bill. And if it means that we can shave off a couple of months of this bill, and that would be my urging to all of you, because the quicker we can get this bill on the statute book and into law, the quicker we can actually get on. And one of the things, I know you haven't asked me this question, but if you'd like to ask me what has frustrated me more than anything else in this first year of government, it is how long it takes to get things done. And, you know, of course, we've got to have the proper scrutiny and all the rest of it. That is essential for good lawmaking. But, you know, it's going to be a year and a quarter, a year and a half before we get this flagship legislation, which we've got a mandate to do because it's in our manifesto, to get it through. And I just would urge people in this place to be sympathetic towards this legislation. I know that amendments can often be useful, but every day, week, month that passes is another day, week, month that keeps the costs of infrastructure investment too high and much higher than they are in comparable countries around the world. You know, the reason that HS2 is not coming to my city of Leeds anymore anytime soon is because I'm afraid, as a country, we've cared more about the bats than we have about the commuter times for people in Leeds and West Yorkshire. And we've got to change that, because I care more about a young family getting on the housing ladder than I do about protecting some snails. And I care more about my energy bills and my constituents than I do about the views of people from their windows. And again, we can have a debate about that, but that is where I stand, and that's why we're making these changes.
And how will you know if they're adequate?
If we get stuff built and if it's cheaper to do so.
Do you have any sort of specific criteria for going, this should be that much shorter? Because with all due respect, if you don't, it's very easy to
look, so this is an MHCLG policy, but absolutely, this is about reducing the time it takes. And you'd already seen, we've got this target, I think, 150 major infrastructure projects in this Parliament. I think we're halfway to achieving that, or something like that. So we've got that target about the number of major infrastructure projects we've signed off. Every week, I get a tracker document, Baroness Wolf, that's about this thick, of growth projects that we want to get on with, and every week it is updated of what change is made. And one that I'm looking forward to getting before the summer recess is the plan from Heathrow Airport for a third runway. You know, we need these investments. There's always going to be people that object to that. I don't say that they are wrong from their personal perspective, But as a country, we've got to get on and build this stuff. Otherwise, we're going to find that our children and grandchildren have poorer living standards than we do, and that would be unforgivable.
Could I just add one thing, which is also about the creation of the National Infrastructure and Service Transformation Authority, which is now situated within the Treasury, and part of their role is going to be working with departments and others throughout the supply chain, through the delivery chain, to identify where the blockers are and then help us unblock them.
Thank you very much. Baroness Liddell.
Thank you, Chancellor. Can we afford the triple lock on pensions? You know, the OBR have said that it will cost £15.5 billion annually by 2029-30. Now, that's an awful lot of money. And are there any scenarios in which you would envisage modifying the triple lock formula?
Thank you very much, Baroness Liddell. In the manifestos, as you know, we made the commitment to maintain the triple lock, and that it remains our policy, and that's the commitment we gave in our manifesto. We have, though, just launched, as I said in the answer to a previous question, the Pensions Commission to ensure that the state pension remains affordable, and also that people have adequate pensions in retirement. And so Susie Morrissey is doing this regular review of the state pension age for us, because as we live longer, especially if that is healthy life expectancy, we should work a bit longer as well. And then also this review around pension adequacy, because the decline of DB pension schemes and the returns that have not been as high as they should be on DC pensions mean that despite automatic enrolment, people still don't have the pensions that I don't think that they deserve. So we're looking at that long-term sustainability. And you know, despite making some changes a couple of months ago to the winter fuel payment, it is now the case that if you earn more than £35,000 a year, if you have income of more than £35,000 a year, you won't get the winter fuel payment, which saves around £400 million a year. That is the right thing to do, because in a fiscally constrained world, it isn't right that working people on ordinary incomes pay the fuel bills of wealthier pensioners. So we have made that change to make the pension system more affordable.
Thank you.
Thank you.
And last question, Lord Liddell.
One of the exciting things we talked about a lot in opposition was radical devolution in England. So the question is, Chancellor, are you prepared to devolve any tax powers to regional to mayoral and combined authorities? For example, discussion of a hotel tax, which might raise money for local cultural investment, which is very strong on job creation? And are we prepared to see a serious devolution of budgets as a result of devolution, particularly, in my view, on skills, where people at local level are much more likely to be able to identify what are the real skill shortages in their area?
Yeah, I'll say a little bit, and then I'm going to pass on to Beth Russell. Beth, as well as being second permanent secretary at the Treasury, also heads up the Darlington campus, which has 8 different government departments. A really different way of working for the civil service, where you might sit next to somebody who's not in the same department as you, which I think is a great innovation. And Beth, as I say, has sort of really spearheaded that. At the spending review last month, we announced the rolling out of integrated settlements to 5 new combined authorities from 26-27. That's in addition to what we've already done in Greater Manchester and for the West Midlands combined authority. And also one of the things which I think will be most transformational in the spending review is the £15.6 billion settlement for 8 mayoral combined authorities for transport investment, which will see I've been an MP for 15 years in Leeds West, and it was long before that they were talking about a mass transit scheme, and we're the first government that have actually committed some money to it. In the North East, the tram will go to Sunderland, and in Greater Manchester, the tram will go, I think, to Bury and somewhere else, and in Sheffield I think it's going to be extended to Rotherham. So, and beyond mass transit, this is also about better bus services, new bus stations, etc. And in the West Midlands it's going to go to East Birmingham and then on to Solihull. But we've also, and again a lot of this work has been led by Beth, a review of the Green Book. Which for a long time mayors, MPs from across the country and across party have complained that the Green Book makes it harder to get investment signed off for places outside of London and the South East, and so we've made significant reforms to that Green Book to make it easier to get that investment to the places that can benefit most from it. But Beth, do you want to say a bit more?
Just a couple of things. So, I mean, you talked about tax powers on existing tax powers. The devolution white paper is extending some of the existing tax powers that mayors have to all mayors. And as the Chancellor said, I mean, I think one of the things that we are doing very differently in government is working very differently with regional government, particularly actually in the Treasury, but across departments, and local growth plans are playing a really important part in that. So one of the complaints from regional government has been that they're having to have individual conversations bilaterally with individual departments. These growth plans enable us to come together in a single place with them to talk about their priorities and how we can work together to achieve them. So I think that's something that's quite different as well.
No on the other 2 points I made.
One last follow-up from Lord Burns. As a former Perm Sec of the Treasury, I'll be remiss in not allowing him a final question.
And I was very sorry, Chancellor, that I was late arriving. Quite rightly, you put a lot of emphasis on the issue about sticking to fiscal rules. In the past, Chancellors have found, of course, that they've had to make quite a lot of changes to those rules as time has gone on. And over the past year, there has been a suspicion that the headroom that was left for uncertainties was possibly not quite as much as was necessary given the uncertainties that we feel. And I just wondered whether you had any views about how much headroom needs to be built into those figures to make sure that we can actually stick to these rules and don't get derailed by changes that we can't foresee at this moment, which has often happened to Chancellors in the last 10, 15 years.
Yeah. I think if the question is, would you like to have more headroom? Yes, of course, we would like to have more headroom.
Build more headroom in.
But Lord Burns, there is a cost to more headroom. And the cost of headroom is either less spending in a world where there are huge pressures on our public services, or more taxes in an environment where Lord Blackwell and others have already pointed out that taxes are an historic high. We did increase the headroom. I think it had gone down to £6.5 billion in the budget before last in the previous Parliament. It's now at 10 billion. We kept it at around 10 billion in the spring statement. We've also made a commitment to move to just one major fiscal event a year to give that greater certainty to people around tax levels, and we stuck to that in the spring statement, where we made adjustments without changing tax rates. So, it would be wonderful to be in a world where we had less taxes, better public services, less debt and deficits, and more headroom. But I guess to come back to Lord Wood's first question, in this sort of age of uncertainty in which we live, how are you, how are you conducting your growth policy and your economic strategy? We're trying to build a more stable and resilient economy with fiscal rules that are clearly understood and will be stuck to, and then using as much as possible non-fiscal levers to grow the economy. Of course, fiscal levers including the investment rule to unlock public investment, but also all the things that are necessary to free up that private investment, because we know there is money available to invest, but it's not going to come to Britain unless we do what is needed to get better trade relations, better planning systems, better regulation, better financial sector, including on pensions, and that's what we're trying to achieve as a government. If in time it means we can build in more headroom, even better. But we're dealing with the world and the inheritance we have, not the one perhaps we might like to have had.
Could I just have one point briefly on this question, as I have a close professional interest in it as well, is that I think that the focus on the size of the headroom, I think, underplays what I think could be a more important issue. Is what really matters is the quality and the credibility of the plan that sits underneath the size of that headroom. And you can have more or less credible plans for very different sizes of headroom. And so, for example, in the spring statement, the OBR showed that we were meeting those fiscal rules 2 years early at the 3-year horizon. We're in a position in which the fiscal rules are being met on the basis of legislated tax increases and spending plans that are underpinned by detailed 3-year spending plans at a departmental level. That's a very strong underpinning to the consolidation path, and I think is at least as important as the size of headroom, given the range of uncertainty that you mentioned.
Thank you very much.
Thank you very much. Well, you urged us earlier on to proceed in a timely manner on the planning bill, and we can assure you we've proceeded on a timely manner today because we've hit 3:30 exactly on the mark. Thank you to you and your team for coming today. We really appreciate it, and I'm sure you'll be setting an example, working hard and raising productivity over the summer, but we wish you at least some time when you're letting your productivity slip at some point over the next couple of months. Thank you very much for your time, and with that, I end the public meeting.